Hey guys, welcome to Andrew Invests. Today I wanted to do another quick video on why I invest in stocks as an asset class, what makes a stock have inherent value, and why it's different to asset classes like cryptocurrency, for example. I want to take you through a balance sheet and the investment thesis behind my investments in both Meta and Apple. And basically explain why I'm a shareholder of those companies. Before I get into this graph, I want to really quickly explain to those of you who aren't aware, what is a share? They're talked about so often, and there's a lot of misconceptions towards them. So what is a share and what is equity? So a share is basically just a slice of a company. And if you own a share, you effectively own a small percentage of a company. So for example, if there is a company that has 1,000 shares and you own one share, that means you own 1/1000th of that company. And that entitles you to a share of all of their assets if that company is ever liquidated, i.e. if they go bankrupt or if they just decide to liquidate, which is pretty rare. It also entitles you to dividend payments. If that company offers a dividend, it will usually offer a certain amount of money for every share that each shareholder holds. So for example, if it is $1 per shareholder, you'll receive $1. So dividend is basically paid for through a business's general cash flow, and all that means is the profits of a company after it's paid for all of its expenses. Now, what is equity? So equity basically just means the total value in a company that a shareholder owns. So they're often used interchangeably. So now that's sorted, let's take a moment to look at this graph. It basically shows the performance of various different asset types over around a 100-year period of time between 1925 and 2014. So you can basically use this tool to read what each line is. And if you look at inflation, for example, US inflation, it basically shows you that $13 now is worth what $1 was worth in 1925. Sorry, $13 in 2014. So you can use this US 30-day Treasury bills as a proxy for keeping your money in cash in high interest savings accounts. So if you had done that, your $1 in 1925 would be now $21 in 2014, which is not that much above inflation. It's effectively around 180 or so, $1.80 or so in real terms. So that's pretty poor, to be honest. That historically has been the performance of cash. So cash is obviously in the short term, there's very little risk, but in the long term, you're taking a huge amount of risk as compared to if you had put that cash into something else. So if you look here now at US government bonds, the performance on that is a lot better. And you can see the power of compound interest here. So this is actually a logarithmic graph whereby each iteration is actually 10 times higher than the last one. So if you see the performance of putting your $1 into US government bonds, you'd have made a 5.7% return, excluding inflation, and you'd end up with around $135, which would be worth $10 in purchasing power, real terms, effectively. So pretty good, but over 100 years, is that really that great performance? Probably not. Now, if you look at the S&P 500, which is probably the most popular ETF that investors nowadays invest in, you can see it's very volatile. The performance obviously drops and rises very regularly. It's not a stable investment, but over time, it massively outperforms cash and bonds. And you can see by the end value is £5,000, which is, around $400. Sorry, $5,000, which is worth around £400 in real terms. That's from effectively having done nothing but just holding. And also, if you look at small cap equities, those outperformed even more. I've made this Excel sheet to basically demonstrate the power of compound interest and to show what a typical investment amount over a typical investment time period, how the performance would be. So right here I've got the rate of inflation from the last graph, which was 2.9%. I've got the S&P 500 average return, which is 10.1%, and then I've got the S&P 500 real return, which is 7.2%. It's just the average return minus the rate of inflation, and then I have an initial investment of $1,000. So if you look at the performance over that 30-year time period, it eventually gets to $8,000, and that's in real terms as well. So effectively, if you can save $1,000 today and invest it, you will have $8,000 in 30 years. If the last 100 years of history, repeats itself, which seems fairly likely. One way I actually like to look at it when it comes to saving money is if I manage to save £10, for example, by not eating out, it will effectively be worth £80 to me in 30 years. And I can get 8 meals with that. Now, obviously, this is all very well and good, but it really doesn't take into account the fact that the vast majority of people are going to be investing money in regular periods. As you earn money every year, you'll invest a certain amount and put it into the stock market, right? So obviously this was also quite a small amount of only $1,000 as well. So if you increase that maybe to like 10,000, you can see obviously it's just 8 times that. So you'd end up with like 80,000. But in this particular sheet, I have added the functionality whereby each year you can have an annual contribution. So for example, the first year you would contribute 1,000, the second year you've contributed 2,000, etc. till the end where you, after 30 years, you have contributed $31,000. So looking at this, by the end you have, $105,000, and if you were to increase this to a more feasible amount, $10,000 per year, you would end up being a millionaire in real terms. Equity is my preferred asset class over other ones such as bonds and even crypto, because it's effectively a way of becoming a part owner in businesses that are working day and night in order to improve their operations, to improve their cash flows, improve the profits they're making. It's effectively the same as me having my own part-time business, which generates me money in, day by day without me even having to pay any attention to it, really. So Warren Buffett famously said, if you don't find a way to make money while you sleep, you will work until you die. And that's quite an apt phrase in my opinion. And by owning equity, I'm effectively owning stakes in businesses which are making me money whilst I sleep. As opposed to other asset classes like crypto, for example, you don't really own a share in anything that is actually producing anything of real value. You might own a token of something that is being used to transfer value around, and that value may go up or down, but the only value of that asset is effectively how much someone is willing to pay for it. So if you buy it for $1, you have to hope that someone else will buy it for more than $1. if you buy a crypto. That's not the case with shares. When you buy a share, you're buying something with real value, because you own a share of an actual business that is producing cash, real cash, on a day-to-day basis, and you also own a share of the assets that that company owns. Okay, so I want to take you quickly through my general process for picking an individual stock. We're going to start off with Meta because it's my largest holding. To start off with, I think you need to have a general belief in the story of a company, i.e., a belief in the future direction of a company, and base that off the current goings on at that company. So right now, Meta share price has had an absolute torrid time over the last year and a half or so, and that's basically been caused by Apple privacy changes, cutting out a lot of Meta's revenue that it was able to generate by tracking users on the iPhone. Obviously, I think that this share price drop is a bit too much. I think the company is currently undervalued. I think they'll find some ways to mitigate some of the privacy changes that Apple has enforced. I also think that the metaverse project that Meta is currently sinking a lot of money into, in order to be a market leader, actually has a huge amount of potential, and I think it's being undervalued by the market currently. So if I also show you guys the fundamentals of the company. So this is the second part of the process. Once you have belief in the story, you need to go and check a company's fundamentals. So at the most basic surface level, you can look at the price to earnings of a company. That effectively just means it's effectively the total market cap of a company divided by its yearly earnings. So on average, the average S&P 500 company, the price to earnings is currently around 15. So on this basis, Meta is valued to have less growth prospects than the average S&P 500 company. Personally, I think that is too low, and I think that Meta will grow by a higher amount than the average S&P 5 company. That will include companies like Pepsi, Coke, things like this. So like low growth companies like that. So that's just the basic surface level analysis. Next, you can look at other things like, for example, revenues. So as you can see, the revenues at Meta have been increasing rapidly. There is a slight drop off here, and I think that may continue throughout at least the first part of 2023. However, I don't think it's drastically down. If I look at the earnings, these have been affected by the privacy changes, as I've mentioned, and also investment into the metaverse. But I don't think this is going to be a long-term issue, personally. Something that I really like about Meta right now is that they're doing huge amount of share buybacks. That basically means that the company is deploying cash in order to buy back shares that it thinks, its own shares, which it thinks are cheap. So if a company is doing share buybacks, it effectively means that you own a larger percentage of that company. Say there's a company with 100 shares, you own 10 of those. If the company buys back 10 of its own shares, you then own 10 out of 90 shares, which is a higher fraction than 10 out of 100. So by Meta deploying their cash to buy back shares over the last year, every shareholder is basically owning 4% more of the 4.6% more of the company. And because the price is so cheap, I think that Meta is going to continue to funnel cash into these buybacks, which I really like. There's also very little chance of Meta going bankrupt anytime soon. If you look at this graph of their total cash on hand and then also their total debt on hand, you can see that their cash is actually higher than the amount of debt that they owe. So they could effectively pay it off today if they wanted, which is very reassuring. So even if the business goes through some kind of short-term pain or even medium-term pain, there's no chance of them going bankrupt and effectively writing off my investment in them entirely. So I personally have a lot of faith in this company, and it's one of my top picks for 2023 and the long term. I think that is probably enough for this video. Thank you all for watching. I hope you enjoyed this video, and I'll see you guys next time.